Welcome to the Deep Dive. Today we're jumping right into the Q3 2025 results from Novartis. That's NVS on the ticker.
Yeah, fresh off the earnings call.
Exactly. Our mission here is to cut through all that immediate post-earnings chatter. Filter out the key numbers, look at the strategy shifts, and really try to understand why the market reacted the way it did.
Because it definitely reacted, gave the stock a bit of a bloody nose right out of the gate, despite what seemed like a pretty decent top-line growth on the surface.
It did. So let's unpack that. We saw the ADR, the American Depositary Receipt, drop about 4.4% pretty quickly after the numbers hit.
Right. And when you see that kind of sharp move, it usually means the market's latched onto something specific, often something in the, let's say, the fine print rather than the big picture strategy. A classic case of punishing a miss, even a small one.
Okay, so let's start with that mixed picture then.
Yeah.
Because the revenue, well, it looked undeniably strong.
It did, yeah.
Net sales hit $13.91 billion. That's up 8% year over year in US dollars.
Which is solid growth.
And it actually beat the consensus estimate. Not by a huge amount, but about $30 million over. So, a revenue beat.
Yeah, the top line was definitely humming along, and that really speaks to the underlying demand for their innovative drugs. But
there's always a but in these things.
There often is. The short-term trading, the immediate story, it was all dictated by the bottom line. The core non-JAP EPS, it missed.
Okay, what were the numbers?
They reported $2.25 per share. The analyst consensus, what the street expected, was $2.27.
So a 2-cent miss.
Just 2 cents.
Wow. It's almost hard to believe sometimes how 2 pennies can seemingly vaporize billions in market cap, right?
It really is. But if you look past just those headline numbers, I mean, the core engine of the business looks pretty solid, doesn't it?
It does. Core operating income margin stayed stable, 39.3% in constant currency.
This is a healthy margin.
And the free cash flow. For the first 9 months, we're talking $16 billion. That's a 26% jump compared to last year.
Huge number. Massive.
So why the laser focus on a tiny 2-cent miss when the company's throwing off that kind of cash?
Well, that cash flow is obviously critical, gives them flexibility for deals, for R&D, everything. But investors, especially short-term traders, they just don't like surprises on the EPS line, no matter how small. And when you dig into why that 2-cent miss happened, well, that takes us into the real weeds of the quarter, kind of the twin issues, generic drag, and some, let's call it accounting noise.
Okay, so the market wasn't worried about demand for the new stuff flagging. It was the older drugs facing generic competition, specifically Entresto, I assume.
That's the main one, yeah. The generic headwind in the U.S., which everyone knew was coming, it really started to bite this quarter. Entresto sales were still huge, $1.88 billion.
Still massive.
But that was actually down about 1% in constant currency. So that pressure's there, it's structural, it was expected, but then it got combined with these financial true-ups.
Okay, true-ups. Let's define that quickly because it sounds super technical.
It is a bit jargony, yeah. Basically, think of a true-up as like a retroactive adjustment to the books. So in Q3, Novartis reported negative gross-to-net true-ups, meaning part of that EPS miss wasn't just the generics, it was also these adjustments. Management pointed mainly to the Medicare Part D redesign. So think of it like maybe some penalties or rebates related to Medicare changes from Q2, they only got fully accounted for or trued up in Q3's numbers.
Okay. So it artificially dragged down the Q3 result because of something that happened earlier.
Exactly. It acted like a retroactive hit that suppressed the quarter's EPS. In fact, management suggested that if you strip out those noise factors, the underlying bottom line growth would have been more like 11%.
Okay. That definitely adds important context to the miss. But it also sounds like it makes things complicated going forward, right? We heard management warn about Q4 modeling becoming tricky.
Yeah, they did flag that.
Is this a sign of a growth stall, or is it just more of this accounting headache spilling over?
It sounds mostly like an accounting headache that's going to look like a slowdown in Q4. Management's guiding for Q4 underlying top-line growth to be only in the low single digits.
Low single digits, after seeing 8% growth this quarter.
Right. But the reason they gave is because Q4 of last year, 2024, had a bunch of positive gross-to-net adjustments. So that boosted the number they're comparing against this year.
So it's a tough comparison. The base from last year was artificially high.
Precisely. They're fighting against a really high bar set by those financial timings last year. So it doesn't necessarily signal a sudden problem with the business itself, just a difficult year-over-year comp because of accounting.
Got it. So near-term noise, predictable generic pain from Entresto. But the whole investment case for Novartis, the whole story they tell, is that the new drugs, the growth engines, are accelerating fast enough to offset this drag.
That's absolutely the core thesis. And you really saw that in the Q3 numbers, too, if you look beyond the headline miss.
What stood out there? The priority brand momentum.
Exactly. They highlighted that their key growth drivers collectively were up 35%. 35%.
Okay, that's huge.
That's the number management wants you to focus on. That's their justification for the valuation, for shrugging off the Entresto generics.
All right, let's run through some of those key drivers then. Kisqali, the breast cancer drug, that one seems to be on fire.
Absolutely. Surging is the right word. Sales up 68% globally. Hit $1.33 billion in the quarter.
68%.
And in the U.S., even more dramatic, up 91%.
Wow.
A lot of that's driven by its strong backing, like the Category 1 NCCN guideline support. That's the National Comprehensive Cancer Network for both early and metastatic breast cancer. It's just aggressively taking share, and management thinks there's still a long way to go. Lots of patients aren't even on this type of therapy yet.
Okay. And Kesimpta, the MS treatment.
Also very strong. Sales up 44%, reached $1.22 billion. Again, mostly driven by U.S. demand. They've got broad first-line access now.
So patients are starting on it earlier?
Yeah, they said something like 80% of patients are either starting Kesimpta as their very first therapy or their first switch. And globally, they still see a lot of potential, noting that most MS patients on treatment aren't actually on a B-cell therapy like Kesimpta yet.
Right. Moving into oncology again, Pluvicto. Radioligand therapy. That continues to ramp up nicely too, doesn't it?
It does. Pluvicto sales grew 45%, hit $564 million. A big part of that momentum is the approval they got for pre-taxane use in prostate cancer. It just opened up the market for them significantly.
And they've built out the infrastructure needed for that kind of specialized therapy.
Seems like it. They mentioned reaching over 730 treatment sites, getting it out into the community settings. And the data looks good, too. That phase 3 PSM addition trial showed a 28% reduction in the risk of progression or death. So strong clinical backing.
Okay, one more from that growth engine list.
Scemblix.
Ah, yes. Scemblix for CML, chronic myeloid leukemia. Sales almost doubled up, 95% to $358 million.
Only 5%. Yeah. They said it's rapidly approaching leadership in terms of NBRX. That's new to brand prescriptions in the first-line setting. So think about it. You've got Kisqali, Kesimpta, Pluvicto, and Scemblix. 4 potential multi-billion-dollar franchises, all growing over 40% at the same time.
That's pretty rare.
Extremely rare. That's the operational power management wants investors to see past the quarterly EPS noise. That's the real story.
And it wasn't just sales momentum. They also delivered on the pipeline front, right? Rhapsido got approved.
Absolutely. Rhapsido, that's their oral BTK inhibitor, Bruton's tyrosine kinase inhibitor. Got the FDA nod for chronic spontaneous urticaria, CSU.
Which is like chronic hives.
Basically, yeah. And this is potentially a big deal because it's the only oral targeted BTK inhibitor approved for patients whose symptoms aren't controlled just by antihistamines. Management threw out a number, maybe 400,000 uncontrolled patients just in the U.S. So significant market potential.
Okay. And there was positive news in immunology, too.
Yep. Cosentyx had a positive phase 3 readout for polymyalgia rheumatica, PMR. They reckon that patient population is about the same size as the market Cosentyx already has in hidradenitis suppurativa.
So another potentially large indication for an existing blockbuster.
Could be. And then there was Ianalumab, positive phase 3 results in Sjogren's syndrome. They're aiming to file for approval in the first half of 2026. It just shows the R&D engine is still humming, hitting its milestones.
Right. So let's shift gears slightly to the bigger picture, the investor context. Despite the Entresto drag starting, despite that little 2-cent EPS miss, management reaffirmed their full-year guidance.
Yeah, and that's a really important signal. That reaffirmation is basically management saying, look, ignore the quarterly volatility. The underlying business is on track.
What is the guidance again?
They're still expecting high single-digit net sales growth for the full year 2025 and low teens growth for core operating income. So the trajectory they laid out earlier this year, they're sticking to it.
Okay, but this confidence, this focus on innovation, it's also fueling some big strategic moves.
Yeah.
The main one being the massive acquisition of Avidity Biosciences. We're talking around $12 billion.
Huge deal. Yeah.
That fits their whole pure play innovative medicine strategy. But $12 billion. Is there a risk they're overpaying, especially since it's going to hit margins in the short term?
That's probably the most critical question coming out of this whole earnings update. The $12 billion for Avidity is all about boosting their capabilities in RNA-targeting therapies. They see that as a key platform for durable growth way out into the 2030s and beyond.
So it's a long-term bet.
A very long-term bet. And they're justifying the price tag by saying you have to invest heavily now to secure that future growth. It's a calculated sacrifice, basically.
What's the cost of that sacrifice in the near term? How bad is the margin hit?
They were upfront about it. Management warned that the R&D investment needed for Avidity will dilute the core operating income margin for a bit. Expect maybe 1 to 2 percentage points of dilution for the next 3 years.
Oof. 1 to 2% for 3 years is not insignificant.
It's not insignificant at all. But, and this is key, they also sounded very confident they can get that margin back up to their 40% target by 2029.
So they see a pass back after the investment phase.
Exactly. And this really highlights that core divergence we keep talking about, right?
Right.
Management is laser focused on building this long-term innovative moat, even if it means 3 years of margin pressure. The market, or at least the part of the market selling off the stock, was fixated on the immediate 2-cent EPS miss and the Entresto generics.
Okay, so seeing that big gap between the market's immediate reaction, that 4.4% drop, and management's confident long-term view, it makes you think about how an investor might play this situation.
Naturally.
So let's pivot to our This Is Not Financial Advice segment. If we were sitting around an investment committee table hashing this out, what kind of trade idea might we pitch based on this divergence in the expected volatility?
Okay, not financial advice, but here's a thought process. You've got a stock that dropped, arguably on noise that was somewhat expected, right?
Yeah.
The generic impact, the true-ups.
Right.
But the underlying story, those growth brands going gangbusters, that probably supports the current valuation, maybe even a bit higher over time. However, that warning about Q4 having a tough comp, the low single-digit growth guidance for Q4, that suggests a sharp rebound probably isn't imminent.
So you're not betting on a V-shaped recovery in the stock price right away, more like consolidation.
Yeah, exactly. It feels like a setup for maybe some...
So use the recent dip as maybe a slightly better entry point for setting up the range, but bet on stability rather than a big move up or down in the next few months.
That's the idea. You're acknowledging the underlying strength, but also respecting the near-term headwinds and the specific Q4 accounting comparison issues that management flagged. It's a volatility play that leans neutral.
Interesting. A play that tries to capture the nuance of the situation.
That's the hope.
Okay, so let's try and recap the core takeaway from this deep dive then. It feels like Novartis is operationally doing what they said they'd do, leveraging really strong growth, especially in oncology and immunology.
Kisqali, Kesimpta, Pluvicto, Scemblix.
Successfully offset that known, anticipated generic erosion from Entresto. But a tiny EPS miss, amplified by some accounting true-ups and that generic drag, just completely dominated the short-term market reaction.
Yeah, the narrative got hijacked by the miss, leading to that immediate price drop. The key question, really, for anyone following this, the thing you should be thinking about is, how quickly can that incredible growth from the newer blockbusters actually fill the financial gap left by Entresto? And what does that imply for their ability to hit that reaffirmed full-year guidance?
Right. And maybe here's a final provocative thought for you to chew on. Management mentioned having capacity for up to $30 billion in deals and licenses this year, 2025.
They did signal significant firepower.
They just spent $12 billion on Avidity to really cement their position in RNA therapies. Where does that remaining capital, potentially up to $18 billion, go next? What other platform or modality might they target to really solidify that innovative medicines moat before the year's out?
That's the multi-billion-dollar question, isn't it? We'll definitely be watching to see where they place their next big bet.